Hello, and welcome to the update on Amati Global Innovation Fund. We do this from time to time, as you know, where we update you on what's been happening with the fund, some of the most interesting themes or innovation frontiers, as we call them, that we're pursuing for our investors, and of course talk about performance contributors, and just a general view on the markets. So with that, I'm glad to have Graeme Bencke, my co-manager, and myself, Mikhail Zverev. We are the managers of the Global Innovation Fund here at Amati Global Investors. And we will start with a quick reminder of how we invest. Of course, important to mention that nothing we say is a recommendation to buy or sell any securities or funds, so do your own research and seek professional advice where necessary. But with that, just a quick recap on how we invest. And some of you will be very familiar with that, but we invest in companies that pioneer, enable, or adopt innovation, where the benefit of that innovation isn't fully priced in. The opportunity we pursue is this. Innovation creates fundamental value. It unlocks growth. It deepens the moats. It creates businesses with what we describe as quality metrics, returns, high returns, and on capital and compelling margins. But innovation is also complex. It's uncertain. It impacts across the value chain, and market isn't always well placed or well equipped to understand that before it happens. So this is a perfect mix for active stock pickers like ourselves. A lot of value creation, but mispriced by the market, inefficiently priced by the market. And we're looking to take advantage of that inefficiency for our clients. To do that, we adopt a set of disciplines. What we call embrace complexity. We are very happy to get involved in fairly technically complex areas, technically complex industries. We do a lot of deep research to get an edge over that complexity. But at the same time, we want to buy real businesses, not science projects. We are not falling in love with science. We focus on valuation discipline. We want our companies to be profitable, cash generative, and well-funded, have strong balance sheets. And we've built very hard. We worked very hard to build an edge in exploiting these opportunities. As a team, we have experience and track record of doing this for, in fact, more than a quarter of a century, each of us, which is frightening, but also give us plenty of experience to fall back on. But we also do a lot of deep work in going to trade shows, speaking to companies, of course, but also reading widely, using a range of technical and a differentiated source of information that we believe give us informational advantage to capture that opportunity for our clients. And the result of that is a portfolio that is quite different, very different from the benchmark, and also very different from many of our peers.
Yeah, and just a quick snapshot for those new to the fund. It is an innovation fund. It's not a technology fund. So at the moment there are 4 sectors that are reflected in the portfolio, and we'll go really wherever we find the biggest beneficiaries for the innovation we're looking at. It is different to most sort of global funds you'll come across. We avoid the sort of high end of the market cap range, so we're not in the Magnificent Seven, for example, and that's really because we're identifying quite specific granular innovation areas, and that tends to lead us to companies that are in the sort of the mid-cap part of the market. So think sort of 2 to 25 billion being our sweet spot, really. We care about valuation. So we model out the earnings forecasts for the companies we invest in, and we ascribe a reasonable valuation to those earnings. And that gives us a portfolio that has characteristics that are not that dissimilar from the benchmark, despite offering much higher earnings growth. And we'll look at that a little bit later in the presentation. Relatively focused, so up to 40 holdings, and we are at 40 holdings at the moment, and very different from the benchmark. So the benchmark is the MSCI All Countries World, and we are typically 98, 99% active share relative to that. So when I mentioned we look at granular and specific innovation frontiers, they are reflected on this slide. So it's a little bit hard to read some of them perhaps, but we're looking for areas that are early, so that we want to discover them before they're sort of analyzed by mainstream funds. And we go about finding them very much from the bottom up, not from the top down. So these are areas like radiopharmaceuticals, industrial bioengineering, or multiomics, for example, all of which are reflected on this slide. And while we don't start with that top-down kind of mega trend perspective, we do find that most, in fact, generally all of our innovation areas do benefit from the tailwinds that are driven by these bigger sort of tectonic shifts, if you like. So, investments in new diagnostics techniques, for example, are supported by the fact that we have aging demographics. And those aging demographics and reducing workforce are also benefiting areas like automation and machine vision. So it's very much a granular bottom-up process, but benefiting from some of these larger mega trends as well.
We're going to get into a bit more detail on a few of those innovation frontiers, but of course, when we meet next in person, we're very happy to go in many of those more granular areas that we show here on this map, if you like, of the entire portfolio. And we'll start with photonics. That's definitely an area that you wouldn't have heard from many investors up until maybe very recently. But it's been held in our portfolio. This innovation frontier is something we were very excited right from the start of our fund over 3.5 years ago. And the central premise of photonics is this. The inescapable laws of physics mean that as we try to transmit more data at faster speed, at higher bandwidth, the copper electronics way of transmitting data by sending electrons through copper wires can no longer cope with the demands of that data transmission performance. We have to switch from electrons and copper to photons and optical fiber, and that's what photonics as an industry serves. Photonics and optical communications is probably a better way to describe it. And it's been the case in telecoms for some time. Obviously, transatlantic cables have been shifted from copper to optical fiber many years ago, and we're familiar with that as broadband users. Our broadband has gone optical, from fiber to the exchange, to fiber to the cabinet, to fiber to the curb, now to fiber to the home, which I would imagine most of us have, because we wanted more of that broadband, faster speeds, lower latency. And the same is happening throughout all the IT networks, and especially in data centers, especially in AI data centers. So this fiberization means that as more and more of this myriad of interconnects is moving from copper wire to optical fiber, there is a demand for specialist optical components, lasers, detectors, modulators, all the bits and pieces that transition, if you like, a digital information into a light. And it's a very technically challenging industry. There are not that many companies that mastered it over the years. And we picked two, Lumentum and Fabrinet. Lumentum is the leader in making lasers for optical communications, as well as optical transceivers, the systems that do the job. Fabrinet is the leading contract manufacturer of these devices. And this is the industry that's really accelerating. At the moment, the market forecast suggests 25% CAGR. That's 25% annualized growth over the next several years through to 2029. A big market, and really getting deeper and deeper. One of the things Lumentum is doing is working with NVIDIA, which of course you will be familiar with, in developing chip-to-chip interconnect, which is now requiring so much performance. It also is moving from copper wires to optical fiber, optical waveguides, and our companies will stand to benefit from that. So that's one of the examples. Away from the beaten track, definitely an obscure area 3 years ago, becoming more and more mainstream as we sit here today, and we've seen some very strong performance from these companies over the past year or so.
Yes, and another one is logistics and retail automation. So this is an area we've been invested in part since we launched the fund, and and have added new holdings as we've gone along, as we've found more and more interesting areas to invest here. So this is the thing, corporations are increasingly benefiting from these investments in automation and robotics. It obviously speeds up their processes. It avoids high wage costs and unreliable labor issues that a lot of companies complain about. And in that backdrop, we've identified a number of innovations which are really starting to be implemented now across the largest players in retail, in logistics, and even in industrial components. Companies like Walmart, you can see them on the slide here, IKEA, UPS. So these are huge global businesses that are really embracing these new innovations to drive efficiencies across the business. An example of that is RFID, so radio frequency identification. These chips are supplied by companies like Impinj, which is the market leader and a company that we've owned for some time. These chips are increasingly being used to tag packages in warehouses or clothing, or even more recently into just perishable food items in supermarkets. Kroger and Walmart are both starting to use these chips now. So they're proliferating everywhere across the supply chain. And we benefit not just from Impinj, but also from companies that make the readers and the surrounding infrastructure, like Zebra in this case. And then there are other areas, things like electronic shelf labeling. You can see a picture in the middle there. And that's produced by a company called Fusion Group. Again, these are not well-known sort of household names, but very specific innovators that are seeing significant growth ahead, we think, from these areas of spending. And then the last area is this kind of sea change we're seeing in robotic automation that's driving investment from, again, right across supply chains. And companies like AutoStore, which is the sort of cube storage you can see in the image there, these systems drive incredible efficiency improvements, not just in terms of cost, but also space, as well as time to access goods and deploy them. So lots going on in this sector, and it's been a big area of investment for us.
Moving on to the next significant part of our portfolio called bioprocessing. The central premise behind this innovation frontier is the way we manufacture medicine is changing. We're going from chemical synthesis, which is what produced what's called small molecule drugs for decades, and not centuries, to biomanufacturing. So effectively using genetically engineered cell lines or bugs to ferment the biologic components that we need to do the job of treating the disease or preventing the disease in our bodies. And the way to think about it, it's a fundamental change in manufacturing mechanism to kind of access this new world of monoclonal antibodies or cell and gene therapies. It's akin to transitioning from an oil refinery to a plant that makes yogurt or cheese. It's a fundamentally different process, which needs a fundamentally different ecosystem of equipment suppliers. And that's really the area that's very interesting to us. We see ongoing acceleration, in fact, in new drug launches. The pharma industry is good at creating this new drugs, at discovering these new drugs, but also acceleration in the share of those new drugs that are biologics from kind of 20 percentage points in early to mid 2000s to now almost half of the new drugs being launched becoming biologics, and more than half in the pipeline that are being developed. So it's technologically inevitable that more and more medicines that we will be using as a society will be biologically manufactured. It's an incredibly complex process. If you imagine what it means in highly sterile environments, you need to grow the cells that produce what you need. You need to keep them effectively perpetual, immortal, so that they don't die off, feed them and nourish them, and then capture that active ingredient they ferment, that they secrete, filter it, purify it, package it. There's an entire value chain of companies that do that, all those stages. You see the process flow of this biomanufacturing at the top of this page, and it's another hallmark of our process. We like industries which are so technically complex that they develop a profitable oligopoly. There are really 4 companies that matter, maybe 4.5 companies that matter in this space: Merck, Thermo Fisher, Danaher, Sartorius, and Repligen, which is much smaller than the other 4. And they all have particularly strong position in a one or several stages of this bioprocess. And that's why we own all 3 of them, or we own 3 of them, I should say, of this kind of small oligopoly of really strongly positioned companies. And these are fantastic business models. They are very profitable, they are very cash generative, but also 70 to 80% of their business is recurring revenues. And they are what the industry calls spec'd in. Once you discover the drug and you develop this very sophisticated manufacturing process using a particular set of filters or bioreactors or other of the specialist equipment pieces, the last thing you want to do as a pharma company is to take a technical risk and regulatory risk of changing the process. So you're kind of stuck with this vendors for a very long time, for the life of your drug, which could be a decade plus. It's a very sticky business, very profitable, very cash generative, growing with the growing ecosystem of biologics, and very high barriers to switch. So we like that, and has been a consistent feature of our portfolio pretty much for the past 3 years.
Yeah, another area that we've been invested in since we launched the fund, really, when defence investing, I have to say, was not really popular. Things have changed obviously significantly in the last couple of years because of things everyone's aware of, conflict in Ukraine in particular, and that has driven a sea change in particularly the European approach to defence spending, and we're seeing a much more now being committed by countries across Europe. But the nature of warfare is also changing. So it's not simply a case of investing in areas that have been the focus for investment for the last 15, 20 years. And we identified 3 areas that we think are particularly important and where there's a lot of innovation happening at the moment. And those are cybersecurity, drone and anti-drone warfare, and space. And so we have investments across each of those areas. Cybersecurity, the company Booz Allen Hamilton is a specialist supplier of services into the kind of the 3-letter agencies in the US, the intelligence community in particular. And they have a very privileged position, but also great technology and great systems knowledge that they're supplying into that space. So a beneficiary of cyber. In the middle, that picture is supposed to sort of give you an idea of how things are changing in terms of vehicles defending themselves against particularly drones. So obviously drones have become a big problem in the battlefields in Ukraine, and just industry defense companies and armies around the world are struggling to cope with how to deal with these things. So there are lots of new initiatives and innovations that are happening. We invest in a couple of different companies here, some that are just parts suppliers, so companies that supply actuators and and slip rings and things like that go into both drones for the actuators, and in this case slip ring for a platform that you can see on that Striker vehicle in the middle. And those companies are Moog in particular, and also L3 Harris has some components here, both of which we own. And then the last picture is space, and space is an area of very significant investment, not only for sort of surveillance purposes, but also increasingly for missile detection. You'll have heard of probably Golden Dome in the US. L3 Harris, which is again on the slide there, is a big beneficiary of that, supplying detection equipment and satellites for just that purpose, as well as a number of other things, such as missile propulsion. But really interesting area for us and a lot going on in defense.
Finally, no conversation in the market today is complete without talking about AI. And we're obviously not oblivious to that fundamental transformation in the kind of IT paradigm shift that is going on. And in fact, we have been investing in AI space from the beginning. We have owned NVIDIA at the start of the fund. We've made good returns for our clients from it. We sold it when it passed $1 trillion market capitalization. You could say we sold early, but it's consistent with our mission of finding next generation transformative innovation companies. We're not going to be an innovation fund that'll bring you Magnificent Seven in a different order. So expect us to continue to push the envelope and look kind of further into the undergrowth, into the detail of the next exciting frontier of innovation, rather than cheerleading for something that everybody else is enthusiastic about already. We are what would describe as pragmatic optimists when it comes to AI. We observe growing use cases of AI in the enterprise. It's still early days. There's still a lot of experimentation, not all of it successful, but it is making a difference in more places, and it is adding value in more places. No question about that. We're also observing worrying signs of circularity and unquestioning enthusiasm and unfunded but astronomical investment commitments in the space. You see that AI funding circular web with everybody funding and everybody else. Both Graeme and I have been working in the industry through the dot-com bubble, and we remember how it looked back then. And we are seeing some worrying similarities in investor and companies' behavior, but we're not in panic mode, just to be completely clear. But at the same time, we also see a lot of industry insiders. You see the photo of Jeff Bezos here talking earlier this year, in fact this autumn, about AI being quote unquote good bubble. It's the sort of bubble that creates a lot of useful infrastructure, even though it burns a lot of investors' capital. Some opinion leaders in the venture capital community, like some of the partners in Sequoia, have been writing about AI bubble for a while and saying that the investment being made today isn't matched by any visibility of revenues to make that investment worthwhile. So again, worrying about a lot of investment capital being burned. We funded the fund, we seeded the fund with our own capital. A lot of our own money is in the fund, and we run our fund as we run our money because it is our money as well as our clients' money. So we're very aware of the risk of permanent loss of capital. And faced with this odds, we say, you know what? We're not entirely sure investing at the heart of AI enthusiasm is the best use of our clients' capital. But at the same time, we're finding some really interesting, sometimes asymmetric, sometimes contrarian, definitely less well discovered beneficiaries of AI. We talked about photonics, Lumentum, and Fabrinet. We also talked to you in the past about memory semiconductors like Samsung and SK Hynix, which also benefit enormously from the growth in AI. And both this memory stocks and this photonic stocks significantly outperformed NVIDIA over the past 12 to 18 months. So it was definitely worth our while, investing off the beaten track in search of AI beneficiaries. But we're also looking for some more contrarian, I feel like completely, in our opinion, mispriced beneficiaries of AI development, like machine vision or IT services.
Yeah, exactly. And we have a couple of names there, but in the interest of time, we probably can't go into much detail. But we do think that's something the market is really getting wrong, IT services. Yeah, so very briefly, the proof of the pudding is in the numbers. We talked about the fact that we care about valuation, and you can see that on this slide. So earnings growth significantly higher than the benchmark is providing. Here showing 25% plus. These are consensus numbers, not our numbers. In fact, we would be slightly above that. But you can see from above the P ratio there, you're not paying significantly more for that earnings growth than the market is paying for much lower growth. So again, we're very targeted about, we care about valuation, we care about buying good quality companies to avoid permanent loss of capital, as Mikhail said. So these are free cash generating businesses. You can see the free cash flow yield there, and strong balance sheets. So typically stronger balance sheets on average than the benchmark. And again, that point about being very different from the benchmark, 98, 99% active share, and mid cap rather than mega cap biased.
Performance, we've turned 3 this summer, so we're almost 3.5 now. So we can look back. We invest with a 3 to 5 year time horizon. So this time onwards is where we're starting to reap what we've sowed at the beginning of the fund and through the first couple of years of the fund's existence. And we're pleased with what we've achieved. We've delivered strong absolute returns. We're ahead of our peer group across most, in fact, all time horizons. And that's without the benefit of Magnificent Seven, that obviously was the dominant driver of returns. And when we look at most of our peers, they are a lot more benchmark aware and therefore a lot more focused on those Magnificent Seven stocks than we are. So we are pleased that we were able to find opportunities, generate returns for our clients away from that spotlight of the upper end of the benchmark, where everybody else is looking. We haven't kept up with MSCI All Country World because such a great proportion of that index that index return is dominated by Magnificent Seven. But we significantly outperformed MSCI All Country World Equal Weighted, which is, if you like, an average global company. Again, showing our ability to find opportunities across the board, not just at the top of the market. And then we looked and we continue to look at what we own and where we make money in comparison to our peer group. And we have set our portfolio to be very different from the generalist global fund. So we go into a lot more technical detail and a lot more technical areas. We're not afraid to go down rabbit holes, as we sometimes call that. Those companies are very liquid. They're big enough to for us not to worry about the liquidity, but they're also not easy for a general purpose global investor to understand. So as a result, if we look at if you like, most popular global equity peers that you might compare us with, our overlap with them is virtually none. A couple of names, a couple of percentage points. But pleasingly also, we've set out ourselves to be an innovation fund that will not bring you a Magnificent Seven different order, and an innovation fund that has an unapologetic commitment to our valuation discipline, profitability, and cash generation discipline. So we invest in real businesses, no science projects. And that sets us apart from some of our innovation peers, which take maybe take a decade-long view, kind of swing for the fences a bit more, maybe are a bit more visionary, but maybe a bit less pragmatic than we are on our 3 to 5 year time horizon. So if we look at our innovation peer group, our overlap with them is again a couple of names, a few percentage points. So very different from many other options available to you in the global market, and we think present a very complementary fit in our clients' portfolios. And equally, now that we're more than 3 years old, we can look back at where we made our clients money. And here again, the picture of complementarity is very clear. If you look at our biggest performance contributors over the past 10 years, companies like Leonardo DRS in defense technology, or Fabrinet in photonics, or Yageo in passive components for electrification, they are very, very different from where our clients would have made money in many other funds. So what we own and where we made clients money from is very complementary to what's available out there on the market, and we're very pleased with that.
Yeah, and because a lot of the things we're trying to invest in are very early stage, or typically, early in their life cycle, so happening but not yet fully deployed. It means that we need to look for information in places that the traditional investment community doesn't look. So this means that we're on the road quite a bit, and we go to visit trade shows around the world. So things like Hanover, Birmingham, Wiesbaden, Copenhagen. This year we've been to. And we're looking for information at the industry level. So, and we get that by attending trade shows, things like Advanced Engineering Show, Defense, Photonics, Wireless IoT, and many others are not on this page. And this is really a great source of information for us, because we see how new innovations are impacting industries before that becomes known to the mainstream. And we get that information by talking to the engineers and the salespeople who are at these shows and who live this industry, full time. And so this has been a huge contributor to our knowledge and insights, and we think a bit of an advantage.
So to summarize, the opportunity we're pursuing is very compelling. AI may dominate the headlines, but innovation is a lot broader than that. And in lots of places across healthcare, technology, advanced industrials, aerospace and defense, there's a lot of innovation that accelerates growth, deepens the moats that the companies enjoy, creates a lot of value. But the complexity associated with that often means it's mispriced or not fully noticed by the market. Perfect opportunity set for active stock pickers like ourselves. We pursue that, dare I say, enthusiastically, embracing that complexity, going to trade shows, speaking to industry insiders in great detail, understanding this in a lot of technical detail, but at the same time remembering we're investing in businesses, not science projects. We're looking for profitable, cash generative, well-funded, strong balance sheet businesses available to us at attractive price, with maintaining that good valuation discipline. And we've built an edge, building on our experience, which both Graeme and my case is multi-decade, but also our professional background, our technical background, and all this foundational work that we talked about just a moment ago that constitutes our informational advantage in capturing that opportunity. The result of that is a portfolio that made our clients money in a very complementary way from where they would have made it elsewhere, outperforming the peer group despite not participating in this Magnificent Seven gravy train that by design we wanted to pursue things other than what's already in the spotlight, and being very complementary for our clients' portfolios. And we're pleased with how the first 3 and a bit years of the portfolio had gone, and as investors in the fund as well as managers of it, we're really looking forward to the next 3 years. So with that, thank you very much for your interest, and of course you can get in touch with us anytime, speak to your Amati contact, or just get in touch with us on LinkedIn, or if you have our contacts directly. Thank you very much, and goodbye.